Welcome to Hit the Brakes, where we dive into the top stories, market trends, and ins and outs of the supply chain. No matter if you're tuning in from the cab of your truck, behind your desk, or on your daily commute, we're glad you're here and we're ready to serve you. Let's get this show on the road. Let's get into the forecast for everyone on the carrier side of the market. If you're tuned in today, it seems like relief is finally coming. We've been, looking for this inflationary leg of the cycle for over a year now. I think everybody spent 2024 just, waiting for it to turn. Didn't really ever materialize. And then I think that most analysts are in agreement that 2025 we're expecting an inflationary year. So for the viewers here, we're looking at the dry van spot market rates for the coming year. The forecast, behind us, and then looking ahead into 25 and 26. Tim, this is your forecast, so where should we start?
Well, yeah, I think 5% is the number we should start with. That's the Q4 year-over-year change, and it's not a great number. It's not what I think a lot of us expected, 3, 6, 9 months ago, but it's a positive 5%. So it's I think shippers are probably very pleased with it.
Right.
But what we can say is that the market has remained in pretty close to balance. I like the phrase dynamic equilibrium. We've been moving out of balance a little bit here and there, and then finding that balance, and it hasn't resulted in a great environment for fleets, but it is getting better, and that supply side is continuing to contract, so that should keep pushing rates higher. And I would point out the whole driver situation. It's one of those variables that can really change the outlook. And I think it's good that we spent a lot of time on that, because if there's one thing that's going to push rates even higher than our forecast, that's it. Is if the driver situation tightens more than we're expecting.
Let me jump in with just a couple things, kind of like bubble up some of the themes we've talked about thus far and how it might impact this. So we've talked about a couple upsides and downsides here. So one, I'll just start with, from like a fiscal monetary policy, any kind of additional movements on interest rates downward. Also, we've got some tax cuts and some potential opportunity there looming with the new administration, new Congress as well. Those are things that are business stimulus. Those are capital stimulus. So I think those two components will probably help us if they come to fruition. And when I say help, meaning to more a lift to this forecast. And also the tariff component. We talked about how it's very, very difficult to forecast exactly what's going to happen. But a very strong impact hitting the ports. If any of this tariff pre-buying comes in above expectations, again, it's hard to really tell until the moment it gets here. But that can have a very drastic impact on what we're looking at here to the upside. If more pre-buying occurs, we could see more of a jolt here in 2025. And then just mentioning back on the ports, I do think that any additional disruption, ILA, labor strikes, things like that, will most likely provide additional lift here. Just that disruption, I do believe, just produces a higher lift to the rate environment. And then like the downsides. So any additional continued strength on Class 8 trucks, like you said, we're kind of waiting to see what happens over the next 2 or 3 months. If those continue to come in strong, that could definitely be a pail of cold water on this to some extent, at least to dampen it some. And then also this kind of opaque kind of supply component of private fleet insourcing. If this trend continues, which I'll just go ahead and kind of throw my opinion on this, I do think that there's going to be some business managers that regret some of this decision making. I personally believe that there's a little bit of trauma response from COVID and having your CEO go on earnings calls every quarter and talk about how you're blowing the budget. And I think a lot of that really is probably a big piece of that private fleet trend. It's kind of well timed with that, so it kind of makes sense to me. And then just the last thing, 2026. Everybody's probably looking at this and saying, "Wait, 2025 in this bull market looks to be pretty brief." It's showing year-over-year deflation to start take effect in 2026, and rates to actually come back down And that really, I think, goes back. Tim, jump in if I'm missing something here, but I really think that comes back to the EPA 27 pre-buy. If we have to go and flood the market with additional trucks that are emission compliant and regulation compliant, then that's going to be additional capacity hitting the market. That's going to be a very prominent challenge when it comes to unit economics and rates.
I think I think you hit it. I mean, that's the main reason that we expect 26 to be down is another overcapacity led downturn. I do think tariffs are also a downside risk, similar to what we experienced in 2019 in that down cycle. That was a very soft freight economy, but yeah, those are the main two reasons we expect things to decline. Of course, like you said, the tax cuts should offset some of that, but timing is of course a little bit different. If we look at the last cycle, we got those tax cuts in 2018, before the trade war really took off. So there was it looks like both of those things could happen in 2026, but we'll see.
I think people in this industry might need to go ahead and buy a neck brace from all the whiplash that they've experienced over the last few years, and what seems to be something that may continue for the next couple as well.
It will be interesting.
Maybe somehow we're all finally getting used to this. I don't know if that's possible, but it's always exciting in this industry, and it looks pretty apparent that 25 is going to be no different. So we'll kind of keep our heads on a swivel here and see what pops up next for us. But that's great. Thank you to both of you guys for taking us through all this material and through the forecast. We did save some time for Q&A, and we do have a couple of questions. We've kind of touched on this a little bit, but not specifically to Open Deck. Let's see, what trends in construction or manufacturing might influence the demand for open deck freight services in 2025?
Well, I'll say like kind of two things that we're keeping an eye on. Like obviously, if construction picks up, then construction materials and a lot of the inputs. You think about concrete, rebar, steel, etc. A lot of that typically moves on open deck. So I do feel like any kind of gains in the construction sector, whether that's new housing starts or even on the industrial side as well, I think that's going to be a big piece of a demand driver for open deck in particular. One other area I'll call out is CapEx on machinery to support industrial production here. So any movements that occur there, and thinking again, like if interest rates continue to cut, it's going to make those CapEx decisions easier for businesses to make. Those machines that typically go into production oftentimes move on open deck due to the dimensions and weight, et cetera. So I'd say machinery going into industrial production will be a big component. Now, one last one, maybe not so much open deck specific, but you think about the inputs to machinery, nuts and bolts. A lot of those are made here in the United States. So I would look out for that as possibly a tertiary kind of industry that could get a lift from this. Maybe not open deck in particular, and those are just a few. I think there's a number of industries I think will benefit from potentially what's looming on the horizon, but just open deck in particular, those are a few that come off the top of my head.
Well said. I think if you look at it from just like the policy perspective, like there were three main acts or stimulus acts under the Biden administration. It looks like the Inflation Reduction Act is the one that's going to be cut the most aggressively. But I think a lot of the infrastructure and the CHIPS Acts, I think a lot of that still continues, and that's just another sort of way to look at it. Of course, a lot of that's utility infrastructure and that type of stuff, but and a lot of it's roads and bridges. We're seeing, we talk a lot about Class 8 tractors, but we also see really good strength in the straight truck piece of the Class 8 market, which is things like dump trucks, cement trucks, and refuse trucks, and those there's been really strong demand for those at the moment too.
What role will sustainability initiatives play in shaping the outlook for freight moving forward?
I mean, certainly less of a role than they had in the past 4 years. It's sort of a non-response, but we didn't really touch on the GHG3 rules, which those we are expecting those to be pushed out, and those don't really impact the heavy duty sector too much until 2028 and 2030 as they're written currently. but those are probably going to get pushed out in the future. There is a set of rules that's took effect in California this year, and is scheduled to go forward in at least a couple of other states going into 2025, although a lot of those states are now reconsidering that at the last minute here. And essentially, those rules push electric vehicles pretty hard, and require certain percentages of fleets and manufacturers' sales to be essentially zero emission vehicles. And those types of rules do look like they're going to get pushed out, and likely revised down as well. So it's that's probably the biggest change, post election. Although there were some Supreme Court rulings last summer that already made the revisions of these rules look pretty likely.
Yeah, I'm glad you did mention electric vehicles, Tim. I think that's one thing that does come up when, particularly thinking about, we're talking about Class 8 truck orders pretty heavily in this webinar. And I even remember back from the ACT conference here just a few months ago. I think it was an executive from maybe Daimler that was there, was just kind of giving an overview of their product, their trucks, their R&D efforts, and what they expect. And one thing that I think that there's plenty there are becoming to be quite a few use cases for electric vehicles, but when it comes to long haul, it's extremely challenged. Just like if you were to try and plan a cross country journey in your Tesla, the charging infrastructure's a challenge. Some routes on the trucking side are not even feasible today with the current charging infrastructure. I think that's a major component of this, and then also the battery technology, the capacity. Yeah, I think it was one of the slides that the speaker at the conference mentioned was something like, I'm like probably getting a number off here, but maybe 30 trucks or so roughly require the same amount of power as the Empire State Building. They're very power heavy, power intensive units. So being able to have the batteries to be able to support that, as well as the infrastructure to refuel, recharge, are two critical pieces to widespread adoption. I don't think we're really anywhere remotely close to widespread adoption, but I do think there are specific use cases, particularly close to home, that do make a lot of sense. And then we're talking about all of this potential Class 8 truck acquisition looming in the future. And one of the big questions is, what kind of truck are you going to buy?
Yeah. One thing I'd add to just the interesting dynamic of the electric vehicles is, while you're exactly right on the costs and infrastructure, prohibitiveness right now, and they do consume a lot of energy, of course, but the energy efficiency is about double the internal combustion engine. So like the best diesels, are pushing sort of 50% efficiency, but the electric powertrain is 90. It's like in the 85 to 90 range, and so. At the end of the day, it'll consume a lot less energy overall, but yes, it's still a lot of energy. And it is going to take a long time to do the development and get these products right. I mean, the range that the OEMs are coming out with is getting better and better. But yeah, this is a very demanding industry, and especially with long haul, that's those infrastructure challenges are very big. I'd be remiss if I didn't come back to Canada. We can say Canadian spot rates are up by even a little bit more than US spot rates. They're actually up 8% in October and over 6% in November. So some of that was there was a rail strike over the summer that tightened things up, and so they're coming off a little bit higher trajectory. They have been sort of coming back down from that, but Canadian spot rates are pretty similar to what we're experiencing here in the US on the dry van side, and that trajectory is up there as well. And one thing we've been talking about internally, which is interesting, while Canada usually does follow the US from a regulatory perspective fairly quickly, we don't see the same level of pre-buying up there. And so that could suggest a little bit better rate dynamic as we look at 2025.
Interesting. Okay, great. Well, thank you. Thank you so much for making sure we circle back there, Tim. Appreciate that. And everyone that joined us today, thank you for joining us. Tim, everyone at ACT Research, we really appreciate you and all of your insights and how you help us throughout the year. So thank you for joining us today. And it's just such a pleasure to have you on here each year. So hopefully we can do this again next year. We really, really appreciate your time.